Hi, my name is Sakine. I'm the founder of Tax Formations, which is a tax consulting firm specialized in entity and transaction structuring. Today's video is a case study on the tax implications of a crypto investment. So, as you know, crypto is new. As a result, there is a ton of gray area in the tax law regarding the proper treatment of various forms of crypto investment. So, in today's case study, I review three different aspects of a crypto investment from a client that I had, and analyze the tax implications of each aspect of the investment. So, the first aspect is that this crypto business entered into a deal where a token went live in August of 2023 and uh, with a 1 year cliff. So in August of 2024, um, the investor's ownership in the token will vest 25%. And then in August of 2025, their ownership will vest 50, the next 25%. Now they own 50. And so on for a 4 year period until their ownership in the tokens has fully vested. So, what is the taxation of that? Upon entering into the deal, agreeing to this 1 year cliff, that was not a taxable event because the investors didn't own anything yet. Nothing had vested. A year later, in August 2024, when 25% of the tokens vest, that is when the investors now own something. The investors have received 25% of the tokens. So at this point, the investor needs to recognize gain or loss on the difference between the investor's cost basis in the portion of the token received and the value of the token received. And this gain or loss would be capital. So now moving on to the next component of this crypto investment. The crypto investment also involves staking. The way staking works is basically you can put your digital assets to work and earn passive income without actually selling them. So this is you own the crypto asset, but you're not selling it and you're making income off of it. What are the tax implications of that? So as income is earned, it would be considered ordinary income. And then when the investor ultimately sells the tokens, it would be considered capital gain income. And the reason it's ordinary income is because this is actually income being earned off of an investment as opposed to income being earned from the sale of an investment, which is capital gain. The final component of this crypto investment involved airdropping free tokens with a zero cost basis. This is kind of common in the crypto world. It was being done basically as a thank you to investors, and the client was wondering the tax implications of these airdrop tokens. Now, here there is no direct and clear IRS guidance on how airdrop tokens should be treated. However, based on my foundational understanding of the way tax works, it is not possible to charge tax on something that is valueless. So therefore, I told the client that I know the answer is the airdrop tokens aren't a taxable event, but as far as proving it goes, we're going to have to play with the current crypto law as it stands, analyze the gray area, and find a way to support our conclusion, which we know is correct, but the law doesn't necessarily give us that guidance quite yet. So that was that was my analysis of the tax implications of a recent crypto transaction. I think crypto is so interesting because there's so much gray area. There's room for a little bit of, you know, structured and well founded creativity, and I love things like that. If you're interested in this conversation, you'd like to discuss further, you have any questions, feel free to reach out to me. My information is in the description box below. Thanks.